So there's two types of investing on this planet, okay? Simply put, there's many, but the basic two types are active investing and passive investing, okay? What are they? Passive investing is you basically set it and forget it, okay? You do dollar cost average, you buy the same amount of the same thing, an index, let's say S&P 500 index. You buy, SPY or triple Q, very low cost. Your dollar cost average, first of the month, every month. I keep saying this on every show. I'm going to keep saying until I'm blue in the face. If some of you are younger, if let's say you're 30 years old, right? Okay. The retirement age supposedly is going to get pushed up to 70 now, but let's say it's 65 or 68. So if you invested $100, just $100 every month, just a single month, $100, okay? 4 people go out to McDonald's today, a family of 4, it's $100, right? Just $400 a month, and dollar cost average into some index fund, such as the S&P 500, okay, ETF. In 35 years, this is outside your work income. This is outside your 401k. This is outside your Roth IRA. This is outside your anything, okay? House, right? Equity that you built. How much do you guys think that $100 a month will turn into in 40 years? So I'm sure all of you have kids. I'm sure all of you have grandkids, and some of you do. I'm sure you have acquaintances, wives, uncles, brothers, sisters. Tell your youngsters, start putting $100 a month away. That $100 in 40 years invested in an ETF in 40 years, outside everything else that they're going to do, is going to turn into $1.2 million. How many of you would like to have $1.2 million? Nobody told me this when I was 18, 20. I think you guys have the responsibility to tell your youngsters, and some of you are going to say now, I'm too old, I don't have time. No. You have time. If you're 50, do it. Your life expectancy is 78 or 77 as a male in this country and 82 as a female. Okay? You have all that time. 20 years, it'll turn into $500,000. There's no ifs and buts about it. It's the power of compounding, power of receiving 10% return. Period. Do it. $100 a month. Okay? So active investing versus passive investing. I'm an active investor. I have passive investments. I have a long-term portfolio and a short-term trading portfolio. My long-term portfolio, buy and hold, where I see the rotation is happening, such as AI stocks, right? Such as some stocks that I believe that long-term, such as Costco, my favorite company on the planet, they have done nothing but wonders, okay? And that's how you create long-term wealth. And then on the short-term side, you try to beat the averages. Okay, so the averages, let's say, go up 10% a year. If you're an active investor, you should be able to beat 10% a year. You guys will think, what's the big deal? It's not that much. Trust me, 95% of mutual funds cannot beat. With all their computers, with all their geniuses, with all their PhDs, they cannot beat the market. They cannot beat the benchmark. So that's why I'm a huge proponent of, if you're not like me, one of the lucky people who knows what they're doing, go DCA. You are going to beat every single money manager out there. Now, there are some brilliant people out there, such as Citadel, such as Bill Ackman's, these hedge fund managers that can return 20, 30, 40% a year. But in order to invest with those people, you have to have certain financial, standing, right? Even just to go in there and invest with these people so you can take advantage of the 20, 30, 40%. Because if at 10% that $100 a month is turning into 1.2, imagine what will happen at 30% a year, or a Warren Buffett type, which you can invest in Berkshire Hathaway. So to me, I beat the averages, but that's with my trading account. And I try to be in my long-term portfolio, I try to be in stocks that will beat the averages handily, such as, I've been talking about this for months on the channel, Carvana, Kava, all these stocks. And by the way, I sold all my Carvana after this last earnings report because I think it's getting a little ridiculous. That was like a quadruple in a year and 2 months on Carvana. Same thing on Kava. That's for 300 to 400%. Market's only done 40%, which is ridiculously high, right? So long-term portfolio, that's active trading, active investing. being a basket of stocks that you think they're going to do a lot better than the S&P 500. Well, active investing has gotten its butt kicked over the last 10 years, period. Because when these ETFs came around, the spiders and the triple Qs, none of the money managers could beat, DCA and passive investing. So most financial experts, I'm not going to call myself an expert, but I kind of know what I'm saying here, that active investing is unlikely to consistently outperform passive investing. In my case, no. In my case, I easily outdo the benchmarks on my long-term portfolio, buy and hold portfolio, as well as trading, side, because I have to keep pace with inflation somehow, right? But more importantly, it is not that hard, people. It really isn't. But hopefully you'll learn that, and then you'll join that little group of 5 to 8% who continuously outperform the benchmarks. And especially when considering the higher fees associated with active funds. Yeah, because when you're part of, like, let's say, hedge fund or private equity, they charge you 2% to get in there, and they take 20 to 25% of your profits. So you have to consider all these things, right? Or some mutual funds are very high cost. So my light is going out. Let me turn that thing off. I don't know why. And the other thing that you have to consider is high volatility, right? On an index fund, the volatility is not that much. On a stock, it could be massive. Okay, so you need to be able to stomach that as well. And active strategies, though, my point now is on all this topic is active investing going to come back if the market eats it? As I am kind of not hoping for at all, but I'm kind of thinking we're going to have a really volatile period. And during the volatility, because market's done nothing but all-time highs, I think 45, 46 times this year. So I think active investing will have its time over the next couple of years, because the other thing is Goldman Sachs put out a massive report actually saying that it's going to be the lost decade coming up. I hope they're wrong. Goldman Sachs, which I think are the golden standard on Wall Street, they said the returns on the S&P 500 going for the next decade is only going to be 3% a year, basically a sideways kind of a thing, right? Well, we just experienced 40% in one single year from October to November of this year, last October, right? So market is not going to do 40% a year. The average is 10%. So what are we saying here? Well, it's either going to be just low expectations going forward for a few years until the next phase comes in, or we're going to have a pullback, which all of you can take advantage of DCA into that. So studies consistently show that passive funds with their lower fees tend to outperform active funds over long periods. I 100% agree. There's market efficiency as well. Modern markets are considered highly efficient, which they are. These used to be decimal days. I mean, from the quarters and eighths, and spreads were very wide. The efficiency has been created by decimalization, and most stocks now on the bid and ask, you're not losing that much. It's called slippage. Modern markets are considered highly efficient, yes and no, because it's also manipulated, making it challenging for active managers to consistently identify undervalued stocks. Well, it's true, because Warren Buffett used to do that really well. I don't know. Can Warren Buffett do what he did 20 years ago, 30 years ago today? I don't think he can, but I'm never going to question Warren Buffett. But I see active outperforming passive coming up probably next 2 to 3 years. So if I'm still doing the channel in the next 2 to 3 years, I will give you guys some wonderful ideas of rotation, of what's going to do well, of buying and holding something, or all these things, right? And I'm doing that now because I'm an active investor, and I'm doing that now. But I think the time is coming up for active investing.